And now, if you look in the lower right-hand corner, it says electronic trading hours here. That is 24 hours in the day. It's as long as it's trading, you're going to see every candlestick. When I click on this, it's going to give you a regular trading hour option, and it's showing that we're showing electronic trading. Predominantly, I'm going to have electronic trading hours showing, okay? But if you're going to be trading in the 9 o'clock hour, if your trade hasn't formed yet, or if you missed something and you just want to be engaging post 9 o'clock at the opening bell, you're going to set your chart to regular trading hours and watch what it does. Looks different, doesn't it?
Very much.
So what's actually occurring is you're seeing the difference between yesterday's closing price, the regular session hours, and that's using 415. It's very confusing because electronic trading continues still, even though when you watch the TV at 4 o'clock, they ring the bell, ding, 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 and they clap their hands like they fucking did something special. They didn't do anything. Then for 15 minutes, it settles. And at 4:15, there's technically the day session is done. But electronically, it's trading until 5 o'clock. And then it stops and it opens at 6 o'clock. So you can see how this quickly becomes very confusing for someone that's never looked at it and studied it. But for the sake of viewing what it is that's important about this perspective of regular trading hours, we have already arrived at what it has done here as a run up and hit it and then move lower, because this is your initial sell side that was set at the opening at 6 o'clock or shortly after. So when the market runs up in here, hits this level, it's actually hitting also the opening range. The opening range is 9 o'clock to 9:30. And it's down there. Okay, so 9:30 is the opening bell. All of this is the opening range. There is no 15-minute opening range. Okay, the opening range, algorithmically, it's 30 minutes. It's 9:30 to 10 o'clock. In that range, it's doing the same thing that I said when we were looking at the 6 o'clock new day opening gap. It's establishing initial buy side and sell side. That's what it's doing in that 30 minutes. Sometimes the market will just break and never have any kind of opening range impact. It just opens where it opens and it starts running. In this case here, we can see that it's opening and trading back up into not a full return back to the previous close. See, it didn't go up there. It just went right to where I gave you the initial sell side liquidity and how to frame it. Goes right to that, does a majority of the closure of the opening range, this where we opened from where we closed. That difference is a gap. So in other words, when they're watching price until it opens up, this is what you're looking at, where we stop trading. Okay, we stopped trading the previous day at 4:15, and then regular trading hours, this is what we're highlighting here, regular trading hours, the next opening tick, the very first print or very first trade at 9:30, it opens up down there. This is the green candle. What is it showing? The opening is the low. Okay, so as soon as you have that, you're going to highlight that entire range and then watch price. You're not pushing buttons. You're watching price to see how it behaves. Normally, not always, normally, when you have such a large gap like that, what will happen is the market will create sometimes it'll open, trade a little bit lower, and then start working higher, drop back down, either take the low it's formed or just like it did here very subtly, and then rally. Why did it run initially straight from the opening? Because we had already taken out this low. See that? And then we worked into that range all the way up to the initial sell side liquidity, not the entire gap closure. That's a huge paradigm shift for people that have asked all the time. How do you know when it's not going to be a full closure on the gap? Well, you're going to implement what I just did here. And all those factors are going to be weighing on whether or not the gap completely closes or not. I like this. Generally, even if the market's going to be bearish and continue going lower after a big gap lower like this, generally you have about a 70% chance. And I say this, now everybody's going to think that means 100%, but it's not. 70% chance that it's going to go back to mid-gap. So there's always a trade available when you have a big gap down like that. That right there, trading back into the midpoint, that is good. And look what it did. It trades, and for people that heard that for the first time, they're thinking, well, he's saying that because it happened. But I have traders that have been with me for 12 years now. And they've heard me teach this before. In mentorship, I've taught this. I can't remember if it was 2022's mentorship or if it was just a regular video I did. But I talked about, no, it was live streaming. That's what I was doing. I was doing live streams, and I talked about how it's easy for the market to get mid gap. So mid gap is really, really, really strong probability. If you gap lower, just find the midpoint, which is what that is. Okay, and you can see it does that, and then what does it do? It goes right back down and just bumps the low. And then you get that run all the way up to the initial sell side liquidity, which could have very easily retouched the close yesterday at 415 or half of that wick. Okay, so I want to talk a little bit about the chart on the electronic trading.